Where the rich park their money. What if the safest place for money isn't a bank? In 2025, the rich are moving capital in ways most people never see, into vaults, art, mobile assets, second residencies, and structures designed to outlast politics. Tonight, I'll show you exactly where the smart money parks cash when storms are coming, and how you can adapt without a billionaire's budget. I'm Felix with Mindful Money and Meals. If you're new here, welcome. If you've been with me a while, you know we go deeper than headlines, following the money to understand what's next. In this episode, we'll break down 10 destinations where wealth is parking right now, why the shift is happening, and a simple playbook for normal investors. Like, subscribe, and let's dive in. Chapter 1. Why the old map stopped working. For decades, private banks handed the wealthy a two-line recipe: stocks for growth, bonds for safety. That map relied on low inflation, stable politics, and trust that central banks could backstop every crisis. The last few years cracked that trust. Inflation surged, real rates turned volatile, bonds lost the ballast role, and politics became a tax and regulation wildcard. The result? The rich now treat asset location, what country, what wrapper, what custody, almost as important as the asset itself. You're not just buying an asset, you're buying a rulebook. Chapter 2. Cash, but smart. Rich investors still hold cash, but rarely as idle bank deposits. They ladder short-term bills, treasury-backed money market funds, and insured cash sweep programs to spread risk across multiple custodians. The goal isn't yield maximalism, it's optionality, dry powder to buy dislocations fast. If you copy one thing from the wealthy, copy this. Maintain a ready-to-deploy opportunity bucket you can move in 24 to 48 hours. Chapter 3. Gold, silver, and bullion storage. Hard money is back. Physical gold remains the keystone hedge against policy error and currency dilution, but custody is the secret. The rich prefer fully allocated, audited storage in politically stable jurisdictions, sometimes outside their home country. Silver adds torque to the same theme: more volatile, more industrial exposure. For retail investors, that can mean a core position in vaulted allocated bullion or conservative ETFs, then a smaller sleeve for silver, mining equities, or royalty companies if you accept higher risk. Think of bullion as insurance, not a lottery ticket. Chapter 4. Luxury real estate. Reimagined. Prime property hasn't disappeared, but the strategy changed. Instead of one mega mansion, many wealthy families now prefer a barbell, one primary residence they truly use, plus targeted utility properties that serve a purpose: proximity to children's schools, passport programs, business hubs, or lifestyle escape valves. They also avoid being over-visible in a single tax jurisdiction. For regular investors, that translates to buy where the numbers work, net yield and demand drivers, and don't emotionally over-concentrate in one city's politics. Chapter 5. Private credit and real assets. With banks tightening standards, private credit boomed. Wealthy allocators like senior secured loans with collateral, floating rates, and covenants. It's not risk-free, credit cycles can bite, but the appeal is contractual cash flow. Alongside it sit real assets: infrastructure, energy pipelines, cell towers, data centers, farmland, and timber. These aren't exciting, but they're toll roads on the economy. For non-accredited investors, public REITs and listed infrastructure funds can approximate parts of this exposure. Just be mindful of leverage and rate sensitivity. Chapter 6. Fine art, collectibles, and culture. Art isn't just decor, it's a store of value with elite network benefits. Blue-chip pieces historically hold purchasing power and sometimes outperform in inflationary regimes. The rich use professional storage, insurance, and lending against art to unlock liquidity without selling. Adjacent categories: classic cars, rare watches, whiskey, and vintage musical instruments follow similar logic: scarcity, provenance, and global demand. Caution: these markets are expert-driven. If you're not an expert, consider fractional platforms or index-style funds. Cap your exposure and never sacrifice core savings for a trophy. Chapter 7. The mobility theme. A surprising signal of the times. Mobility equals freedom. You'll see wealthy families choose high-end motorhomes, yacht timeshares, and serviced apartments, not as status toys, but as flexible hedges against being stuck. The meta lesson is powerful. Build a financial life that can pivot geographically and professionally. A second residency, remote-capable income, or even simple things like international bank accounts can be worth more than squeezing an extra 0.5% from a bond. Chapter 8. Crypto, tokenized assets and digital custody. Despite volatility, crypto remains a meaningful sleeve for the risk-tolerant wealthy. Many allocate to digital gold, Bitcoin, a venture-style sleeve, select Layer 1s or infrastructure plays, and stablecoin cash rails for international settlements. The biggest change isn't price, it's custody. Multisig, hardware wallets, and professional trusteeship reduce single point of failure risk. We're also seeing tokenization of real-world assets, fund shares, real estate interests, even art, with instant settlement and 24/7 markets. If you dabble, decide in advance your maximum loss, separate long-term cold storage from trading, and document heirs access procedures. Chapter 9. Tax jurisdiction and rules arbitrage. Where is the asset is now followed by whose rules apply. Wealthy families diversify by jurisdiction, one country for residency, another for company incorporation, another for storage. The aim is not evasion, it's resilience, limiting the risk that a single policy change can confiscate time, capital, or opportunity. For everyday investors, you can emulate this on a smaller scale. Use tax-advantaged accounts, know your double tax treaties, and avoid overexposure to any one government's policy whims. Chapter 10. Family governance and structures. The rich don't only buy assets, they build containers. Trusts, foundations, holding companies, family charters, and investment committees clarify who decides what, when, and how. This reduces family drama and sell at the bottom panic. Adaptation for normal investors. Write an investment policy statement, IPS. Define target allocations, rebalancing bands, when you add risk, and what triggers selling. Clarity beats emotion. Chapter 11. The Playbook for Non-Billionaires. Here's a step-by-step blueprint you can use this week. 1. Build an all-weather cash system. Ladder short-dated T-bills or use government-backed money market funds. Keep an emergency fund plus an opportunity fund. Separate them. 2. Add hard asset ballast. 5% to 15% gold and/or silver, depending on risk tolerance. Favor allocated storage or well-capitalized vehicles. Treat it as insurance. 3. Diversify income streams. One W-2 job or one client is risk, not safety. Aim for a side income that remains viable in downturns. Consulting, digital products, or rental yield. 4. Choose real estate by math, not emotion. Focus on cap rates, employment drivers, population inflows, and landlord-tenant laws. If the numbers don't work on conservative assumptions, pass. 5. Consider real assets and listed infrastructure. A small sleeve in utilities, pipelines, towers, or data centers can diversify away from pure tech beta. 6. Create a mobility plan. Second bank account, a travel-ready document kit, cloud backup of critical files, clarity on where you could live for 3 to 6 months if needed. 7. Be intentional with crypto. Decide your long-term allocation, for example, 1 to 5%. Write rules for custody and rebalancing, and never use leverage you don't fully understand. 8. Write your IPS in plain English. Targets, ranges, contribution plan, rebalancing schedule, and the exact conditions under which you can break your own rules. Chapter 12. Red flags and common mistakes. Chasing yield without understanding counterparty risk. Over-concentration in home country politics or one employer's stock. Using collectibles as core savings. Forgetting liquidity. Owning what looks great on paper but can't be sold when you need it. Ignoring tax drag. Sometimes the structure matters more than the asset. Chapter 13. Scenario thinking. The wealthy plan for regimes, not single outcomes. 3 to rehearse. Sticky inflation, hard assets, pricing power equities, short duration income. Disinflation, slow down, quality bonds regain value, defensive sectors, cash optionality. Policy shock / tax reset. Jurisdiction diversification, portable wealth, legal structures, and clear documentation. Closing, the one question. Ask yourself, if you had to protect 10 years of purchasing power through inflation, policy change, and market shocks, what mix of assets and locations would you choose? That question is the compass the wealthy are using right now. You don't need a fortune to think like them. You need a plan, rules you'll follow, and the humility to adapt. If this helped, tap like, subscribe, and share with someone who needs a plan before the next storm. In the description, I've linked a simple IPS template and a checklist to build your mobility plan. I'm Felix. See you in the next deep dive. Stay awake, stay aware. This is Felix. See you next time.